Hey, welcome back everyone. It is time for another red hot cover call video. Well, hey, look, today we're going to talk about the dividend paying fund or distribution paying fund, that being WPAY. Today we're going to talk about WPAY because I own 424 shares. Now, I write covered calls and sell cash secured puts. I generate a premium profit. We take that premium profit, for which is free and clear after we pay the tax man, and we buy WPAY. Now, WPAY is a collection of weekly paying single stock funds from Roundhill. Now, we're going to talk about how this trade works because most everybody that's watching this video, if you don't understand how a dividend paying fund pays its dividend, then you're just literally flying blind. This is where a lot of the yield max and defiance investors, they didn't understand why their funds kept going down and down and down. It's because they were paying those huge monthly dividends. It's called NAV erosion. So they had NAV erosion happening to all those dividend paying funds, and now everybody's upset. So if you don't understand how something derives its dividend or distribution, you need to sit back, educate yourself. So, in this video, I hope to share a little bit of my knowledge and experience with WPAY with you, because everybody loves WPAY. There's videos everywhere saying they're buying WPAY on margin, and they're doing all these things where they're ripping profits and this, that, and the other. They never talk about how WPAY creates its distribution. A lot of times you truly don't want to know how the sausage is made. All you want to do is eat the sausage. So that's where WPAY is able to do what it does behind the curtain. All it does is pay out these incredible fat weekly distributions. I'm calling it distributions because this is 100% return of capital. WPAY is nothing more than a basket of funds that Roundhill has created. We're going to talk about this. I'm going to show you I own Amazon and I own Facebook or Meta's version of this. All they do is return you your capital. You literally pay WPAY and they work their magic behind the curtain. They use swaps and derivatives, and next thing you know, you're handed a per share distribution every single week. Let's talk about that. This is a return of capital play. So if you give Roundhill your $52 a share, because we're going to assume it's $52 a share in this video, okay? If you give them $52 a share, the idea is through weekly cash distributions, they're going to give you your money back. They don't actually say this thing will make you money. And there's no guarantee of capital appreciation. Now you say to yourself, well, everyone says that. But with WPAY and all the single stock ETFs that are considered the weekly pay universe that is Roundhill, you need to understand you're getting your money back. And hopefully, the share price is still up a little bit. So now you can collect those distributions weekly and not really worry about the share price of your investment, because you will have been given your entire investment back. And then, of course, all those shares are free and clear. So, talking about WPAY. So look, if you like anything you hear, I want you to subscribe to the channel right now. Subscribe to the channel. And I also want you to bang that like button. It lets me know you like what I'm doing. And what I'm doing is talking about WPAY and how it works. And also, if we were to go on margin with WPAY. And also its distributions. So look here where over the past 4 weeks, it's paid 73 cents a share, 88 cents a share, 51 cents a share, and 54 cents. Chances are with the market having such volatility, it's going to pay a lot this week. This would be week ending October 17th. This is a return of capital play. They actually tell you that their most recent distributions should be estimated to be 100% return of capital. And they have files and documents that you should be reading. Now let's take a look at what's inside of WPAY. See, WPAY is nothing more than just a container. I want you to imagine a container, and it includes some things. Well, what it includes are the Roundhill single stock weekly pay ETFs. Now, these ETFs use swaps and derivatives to generate a 120% daily return of a stock's movement. So imagine Amazon moving 10% today. Well, its WeeklyPay ETF, you see it right there at the bottom of the screen. AMZN is Amazon. Its weekly for Roundhill is called AMZW. They own 6% of that ETF in WPAY. So if you go to WPAY's website, and I have it here at the end, you're going to see its current holdings. These are the majority of its holdings. Notice that AMD is conveniently 9%. How did that happen? It's very interesting that WPAY announces its dividend on Wednesday. And I just got a dividend from Amazon and Meta, I believe on Monday. Isn't that interesting how AMD, which has been a dog for months, rockets over $220 a share, and all of a sudden WPAY has a 9.5% allocation. Boy, I'd love to have records. I would love to have print screens of what AMD's allocation in WPAY was prior to that. Now, I don't know the flexibility of Roundhill if they can foresee what funds are going to pay the biggest and then allocate that. I'm not sure. I don't know. I'm not making accusations one way or the other. I don't know. I'm just telling you, how convenient is it that AMD is 9.5% and this thing has just rocketed last week? Now, with that said, I love that because I own WPAY. So I own WPAY. So I like that idea. Now, again, WPAY is nothing more than a container. Inside of the container are these weekly pays. Now, the weekly pays are going to kick down a dividend. And in fact, AMZW paid 50 cents this week. My sheet is not even up to date. They paid 50 cents and I knocked it down. Now, that was return of capital, and luckily, AMZW has moved higher. These are momentum plays. These are directional plays. If you buy AMZW like I did, it's a directional play. This thing was trading for over $54, and the thing is now trading for less than $45. This is a directional play because it moves 120% of a daily move of the underlying. That would be Amazon, okay? So when it goes up, you're living life. When it falls, you're getting kicked in the nads. But they're going to keep kicking out that return of capital to you. Now, how they determine that, man, is truly behind the curtain. I'm not sure how they decided to give you 51 cents in this market, but how about all of these? Look right here in the middle. Look right here in the middle. That's when Amazon stock is tanking. Okay, that is tanking because Amazon fell from over $225 all the way almost down to 200. That's Amazon doing that. How is it paying out all of these big dividends? Again, it's the secret sauce. They're using swaps and derivatives, and it's all done behind the curtain. So how can something fall and they then give you fat, incredible weekly distributions? It's because they tell you they're giving you your money back. Now, how they determine that, I'm not sure, but hey, I'm going to take it. Because I'm going to play this like a directional play. I'm going to buy these when they're at the bottom of the range. Because there's a chance that Amazon is going to go higher and my AMZW, while I collect this return of capital, is going higher. Do you understand that they don't sell premium like any of the others. They don't write covered calls. They don't do puts. They don't do dailies. They do nothing. They use swaps and derivatives. And I'm going to tell you now, if you don't know what swaps and derivatives are in the stock market, go to YouTube and watch the videos. In fact, I have one at the end of this video. Just click the link and go watch it. Now, AMZW has been around since June, it looks like, okay? It probably kicked off at $50, and here we are. It's now trading for under 45. Look at what they've returned of capital in 15 weeks. $6.24, and that's not even including the 50-cent distribution. So here is how you need to look at it. You give them your money, and they're going to give it back to you. And what you hope for at the end is that you still have some share value in AMZW. And then every single week, AMZW is just going to give you free money, free money, free money. Return of capital. Now, we're going to talk margin right now. I think I've explained what WPAY does. Now we're going to talk about WPAY using margin, because a lot of people out there are talking about this. Because, look, WPAY is going to pay 50 cents to 80 cents. It's just set up that way. It's a container. It has all those other ETFs in it that are feeding them dividends. They actually have to own the ETF like I showed you, but they're going to get paid all those dividends. They just push them out. You're actually diversified if you buy WPAY. We're going to talk margin. In the description below, I have the smart guide to using margin for dividend investing and income. You can look at this trade as income, distributions, dividends, however you want to look at it. But at the end of the day, if you're going to go on margin like I'm going to show you, you need to do it smartly. And I have the guide. You get the phone app, you get the calculator, you get the video series that's inside of the calculator. Got 10 videos there when I used IWMY for a margin trade and how IWMY paid down my margin. You need to know how margin affects your cash flow and how it affects your account. You have to understand how margin works, and you have to give yourself a buffer. I teach you that in my guide. It's in the description below. Get your smart guide to dividend investing and income. Now, let's talk about going on margin with WPAY, because a lot of people are talking about it. So WPAY right now is anywhere from 50% to 80%, depending on your brokerage. Hey, look, man, this is leverage. They are using leverage to pay you your distribution, right? Because inside of WPAY is all these other single stock ETFs that use leverage. And if those things fall, you are getting crushed. Now, if they rally higher, you're getting the upside. I hear some YouTubers talking about that, where covered call funds, they will not recover because they're always collared, right? They write a covered call, so that means if a stock rockets higher, they are collared because they can never go high because they wrote a covered call, made the premium, and sent it to you as a dividend. Now, Roundhill's weekly payers are not collared. But what I'm also going to tell you is they don't sell premium either. They're literally using secret sauce with swaps and derivatives to give you your money back. Do we understand this? You're giving them your money, and in return, they are giving you a per share distribution. So if it takes 2 years for those distributions to pay for your entire investment, that's what you're doing. And what you're hoping is at the end, they paid you back and now you have shares. Those shares have value. And what you're hoping for is that it keeps paying you, which is now free and clear. Do you understand the trade? Because if you don't understand the trade, all these people on YouTube that are telling you how they're knocking it down, making all this money, you get all this upside, you are going to feel stupid when you find yourself in a bad spot. What did I say at the beginning of this video? Understand how a dividend paying fund derives its dividend, or in this case, how they provide you that distribution. And again, you can call this income. It's not a dividend. It's a distribution. It's a return of capital. Hey, feel free to correct me, but this is from their website, okay? This is from their website, 100% return of capital. Now, let's focus. We're going to go on margin. We're going to use WPAY. It's a 50 to 80% margin requirement. We're going to go with 50 because my brokerage shows 50 at the time of this video. So that means if I'm going to have $10,000, and by the way, the smart guide to using margin for dividend investing and income, you have to use it because that guide that I wrote tells you how to set up your accounts also and what to expect. Because when you go on margin, your cash flow is over. It feeds the margin now. In fact, if you take money out, you're actually taking a loan against your margin account. Got to know that. Got to get the guide, man, in the description below. Now, $10,000 in cash, we go on margin with a 50% margin requirement. That means I can buy at $52, 192 shares of WPAY. Because I'm on margin, that being the stock market credit card, I can now buy 192 shares of WPAY. I have 384 shares of WPAY. Here is something that actually is really interesting. Within a year, this investment can be paid off if WPAY averages 55 cents a distribution. So you get the setup. $10,000, we can buy $10,000 on margin. We have 384 shares total. Now, your debt obligation would be $10,000 on margin plus your margin interest debt. That's your interest rate. So if you don't have a good interest rate, then this is not going to work. In the guide that you can get in the description, I have an entire chapter of how you negotiate down your margin interest rate. You want to do that. Now, there's no taxes with Roundhill. The website says that it's 100% return of capital, but that's them saying it, not me. It's clear as day on the website, 100% return of capital. Be cautious of that because that could change. That could change. Because it doesn't say it is guaranteed, written in ink, that is your blood, that it's 100%. They can change it, and funds have. Now, we're going to assume that you have 6.5% margin interest because that's what something like Robinhood would give you. With that setup, 55 cents per week dividend. I should have put distribution there, but we're going to go with 55 cents. You've already seen what they paid. 81 cents, 71 cents, 51 cents, 50 cents. So it's probably going to come in, on average, 55 cents per share per week. So here it is. 55 cents. This is an average. 52 weeks for 384 shares. This is 1 year. You would return in capital $10,989 in cash flow. That's going to pay back your margin, right? You only went on margin for 100% for $10,000. So right now that's going to pay that off. Check out your margin interest debt. If you were at 6.5%, you would pay an annual rate of $650 or $54.17 in a month or $1.78 a day. This is where this trade gets interesting. Because if you were to go on margin for $10,000, you would buy equal amount of shares, 55 cents on average. Okay, that's a disclaimer, on average for the year. You would make in cash flow $10,989, pay your 6.5% margin debt throughout the year, which is $650. You would clear basically $10,332 in this trade, and it looks to be about 11 months. If you were diligent and kept this trade on and just let that 55 cent per week distribution pay down your debt, pay down your margin debt, you would be out of this trade in 11 months, and you would own 192 shares free and clear. Because you paid down the margin debt with this combination of cash and on margin, 384 shares. Now, here is the deal. The end result is you would gross 10,332 or 182 shares free and clear of WPAY, and that would generate, for 11 months from now, you pay all this down, that would generate $100 a week on average for as long as you held WPAY. Now let's talk about the risk, because nobody wants to talk about the risk, but I'll talk about them. First of all, the dividends or distributions can vary. We use 55 cents as an average distribution, but that can change. We've already proved it. It could be 81 cents, and it probably can be lower than 50. So these numbers will change. And by the way, they could actually change in your favor. If WPAY starts kicking down a 70-cent dividend every single week, you could be out of this trade earlier. Now, tax treatment. You could see right there, tax treatment. The distributions are mostly non-qualified ordinary income, so your after-tax yield will depend on the bracket. Well, they say 100% return of capital. But again, they can change that. What I'm going to suggest you do is when you finally close this trade, I want you to pay some to the tax man. I want you to take 5% and throw it to the tax man. Buy something like XDTE, hold it until it's time to pay the tax bill, and you're done. The rest of it, obviously, you'll have in WPAY shares. Now, the final one is your market risk. This would be a margin call. So in this example, if the stock were to fall 20 to 25% in this scenario, you'd get a margin call. It's because of that 50% margin requirement. The financial institution wants more capital. So you're going to have to put up more collateral or capital. So be aware of that. If this investment falls 20 to 25%, you're on the hook for a margin call, which means you're going to have to sell depreciating assets. And I'll tell you, you're going to have to take a loss. I know some out there on YouTube will say, well, this is money you didn't have anyways, just sell. Look, you're taking a loss. Do you understand? Understand the risks. Now, in the description below, you get your smart guide to using margin for dividend and income investing. I want you to read the chapters where we talk about the 30% buffer, where, and also how cash works in a margin account, and the risk and rewards of a trade like this, because you'll use the margin calculator that you have access to. And hey, on your downtime, watch my journey with IWMY, where I ended up generating over $10,000 in income using IWMY, paying off all the margin debt, paying off all the taxes, free and clear cash flow using other people's money. In the description below, get your very own phone app, guide, and margin calculator. Hey, look, I'm going to leave it right there. I want you to stick on YouTube. I want you to search for Equity Swaps Explained and watch that video. And of course, if you want to know more about Roundhill, by the way, this is not an ad for them, but hey, I want you to be educated. I don't want you to be stupid and go out and buy something just because they pay a fat dividend. That would not be smart. What I'm trying to do is up your game. Go to their website, search WeeklyPay ETFs. Hey, look, I'm going to leave it right there. Be safe, be healthy, most important, be lucky. Until next time, may all your covered calls be profitable.